Recording in progress.
Okay, all set to go.
Okay, now I'm calling to order the meeting of the Kitsap Public Facilities District Board of Directors on 19 January 2023. This special meeting will cover financial issues. So do we have anyone with public comment to begin?
We do have two that are out there. I don't know if either one wants to make a comment. We have Mr. Anderson and Mr. Town.
Okay. We have no public comment?
I'm just waiting to see if they raise their hand or respond. Mr. Anderson?
No comment. Thank you.
All right, thank you. Mr. Town?
No comment. Thank you.
Thank you.
Okay, with no comment, then what I will do is I will turn this over to the Executive Director and the financial advisors to begin their presentation.
All right, well, thank you, Mr. Chairman. Board, great to be back again, back into the new year. We've got, I think it's going to be a busy year for us, but I think part of the reason why myself and Chairman Hatchell thought it was so important that we get together at the beginning of the year was because it's vital for us to know where we're currently at financially, and then we know that we've had projects that have asked for funds, so what does that look like for our future, right? And so tonight is just strictly a question and answer session. We won't be taking any motions, we won't be making any votes, but we have a great financial team with Northwest Municipal Advisors. So we have Scott Bauer with us here tonight, and he's going to be able to answer questions. We have Ryan Neumeister that's online, and Ryan's going to be running through the presentation. That's a presentation that I put in front of you. And then Ryan, as we ask questions, he can put things into the model. So you can take a look and see if you've got questions and things that are different and so on and so forth. So remember, we got a couple hours. Don't hesitate to ask questions as we go. I'm going to mute myself from this point on. I'm going to let Ryan and Scott take it over. And then if there's anything I can do to assist, please don't hesitate to ask me, okay? All right, so Ryan, I know you're a panelist, but I'm going to turn it over to Scott. Scott, did you want to make some introductions or say a few words before we get going?
Again, Scott Bauer, Northwest Municipal Advisors. So thanks for having me here. And as you see, then Ryan is online, so he'll be taking you through the presentation that is in front of you. As Russ mentioned, we've put together a model. I think some of you have seen it before. It's been updated over the past several months as we're trying to put in not only your current state, projects that you've approved, but then also looking forward to projects that you potentially may approve or are looking at, and just trying to show you sort of the impact to your revenues that will be coming in over the next several years. So I'm going to pause here and I'm going to turn it over to Ryan and let him take you through it.
Great, thanks, Scott. And I am sharing my screen now. Hopefully everyone's able to see it okay. And I'll do my best. I know even with the handouts here, you will have to zoom in at moments because it is hard to see in some spots. But what we're going to do is we're going to walk through the current position that the district is in. Then we're going to run through the various scenarios that have come from the entities for the projects that are out right now, as far as what their either next phases are or additional requests due to cost increases. And then finally, we'll go through some questions that we have kind of still posing, for the district to contemplate, as well as to think about, I guess, through the next set of ILAs, and then even stress testing the scenarios as we have them right now. So, well, first of all, we'll walk through. And I guess feel free to interrupt me at any time with any questions as we walk through this, and I'll try to pause at certain spots if anyone does have any questions. So we're going to walk through the current ILAs for the district. We have the City of Port Orchard has a $12 million ILA for the Community Event Center. Just over $10 million is remaining on this to be dispersed with cash and bond. We'll show where we've gotten a timeline from them. We'll show where they expect when to need that money for this project. We have the City of Paulsbo. They have a about a $250,000 ILA for the perk. They have $58,000 remaining on that to be paid. We're expecting to be paid in cash over the next year. Kitsap County for Port Gamble Heritage Park has a $1.7 million ILA. $932,000 remain to be paid out from that for that project. And the Port of Bremerton has a $1.4 million Circuits of the Northwest project. $53 remains to be spent by the Port of Bremerton, and we'll show how we have expected them to make those payments. The district has already agreed to how they're going to make the payments on this going forward for the next 10 years. We'll demonstrate that here. So this is where we are right now. What we're going to assume for all the scenarios is that we see a 2.5% annual sales tax revenue growth increase from through 2041. We're expecting a 1.5% annual operating expense increase through 2041 remaining here. We have the $1.3 million in cash for the Port Orchard project. They've given us a timeline here this year and next year to pay for those. The bond is for the $8.8 million is to be paid there. We have the $59,000 disbursement for the perk this year. And the $932,000 for the Port Gamble Heritage Park project. We have not received a timeline from them for how this money will be paid out. We've lumped it all into this year. It's very possible to be, dispersed over a number of years. But I guess moving that number out farther will not affect the district in any way. So we've kind of put it here, kind of as if it was all spent now as opposed to over time.
Ryan, is it possible for you to zoom in a little bit on your end?
I will. As soon as I'm done with this, I'm going to zoom in. We'll go through line by line what all this is.
Okay, thank you.
Okay, thanks. Yeah, I know there's a lot here. And then the $144,000 for the Port of Bremerton project we paid out here. So let me zoom in now, and we will walk through line by line what each of these are. So we have the tax rebate, and the hard line here is what we believe is finished for 2022. I know Russ has the final numbers for financials for 2022, so we may have to edit those slightly, but these are pretty darn close to what I've gathered from all the information that we have so far. So we have your tax rebate, your interest earnings, then getting to your total revenues. Your operating expenses is here in line 4, with your net available revenues available for debt service. The existing debt is the debt that the district has outstanding, that the county, on behalf of the district, they have the 2015 bond, which will finally mature in 2026. The 2021 bond, which was refinanced, that we defeased the 2026 maturity, so that final maturity is in 2025. And then the new bond that we did that refunded that 2026 maturity going all the way out to 2041, allowing you to continue to have revenues through 2041. And then we have this pro forma debt service. We'll use this column more as we move into the next phases, but really what we'll focus on is the pro forma debt service coverage ratio. And what that number is how much revenues you have coming in to how much debt you have outstanding that you're going to owe on. And so as we see, as the debt falls off, particularly on that 2021B bond, you have over 2 times coverage. Certainly it loosens up from there. So we're going to show a couple of scenarios as to what would happen depending on who's going to bond for the various projects coming forward here. Then we have the money that's available for the ILA payments. We have your fund balance, so your reserves essentially rolling over from the previous years here, and we can sum those up is really what you can use for any of your projects. We have your Port Orchard project is the first one here in blue. The Perk project in green. The Kitsap County Port Gamble Heritage Park project, and then the Port of Bremerton project. So we do say that the district is currently in a very strong position. But with the additional ask, and the district certainly knew as the projects were approved that additional ask would be coming for a lot of these projects. So let's see how these requests now will layer in. The requests are, the city of Port Orchard has asked for an additional $6.5 million to fund, that would be used, the funds would have to be for a reserve for the account if the district issues the bond, pay cost of issuance, and they've asked the district to pay debt service, both principal and interest, for the Port Orchard Community Event Center. The city of Paulsbo has asked that they will issue the bond for $7.8 million. The Kitsap PFD will pay the debt service and cost of issuance for this bond. And Kitsap County has asked for an additional $350,000 for in 2023 for phase 1 of the Port Gamble Heritage Park improvements. So in the model I just showed you, what we're going to do is walk through each of these individually, and then we will cumulatively put them together and take a look at what it looks like with them layered on top of each other. But let's first take a look at them each in individual requests. So the city of Port Orchard asking for their $6.5 million request. What we're showing here in this assumption is that the city would issue the bond. The first column here is for the $8.8 million. The second column is for the $6.5 million and cost of issuance. The interest rate we're assuming, because the bond won't be issued until 2025, is 4.5%, with debt service paid by Kitsap PFD from 2026 to 2041. The city has asked that the district issue the bond. And so we're going to show that here, that if the KPFD issues the bond with sales tax revenue backing, we're estimating that the interest rate will be about 1% higher than if the city was to issue the bond. A reserve account we expect would be needed, and so we've put that into the model at this time. And we're looking at the cost difference between the district issuing the bond and the city issuing the bond of an additional $2.5 million over the life of the bond. You'll notice here that there are no principal or interest payments, debt service payments in 2041. The reason for that is that the reserve would be used to pay off that maturity, because you have the money already set aside, and so you don't have any debt service payments at that time. Another thing to note, and I'll zoom in on this right now, is that we're looking at the debt service coverage, as we talked about earlier. You know, we had the over 2%, almost 2.5% in the previous year, but with this additional bond here for the district, it really drops your coverage down to 2.27. I think, as we may have talked earlier, I mean, we're, you know, 1.25 is really the bottom limit for lending for these for an issue. And so once we start dropping, and when we get close to that number, we just want to keep an eye on that. Certainly you have some flexibility as far as structuring of the bond to maybe alleviate that at the time, you know, if the district was to issue the bond. But that's just something we're going to continue to keep an eye on for the district as we get closer. And really what we'll notice that is during the stress testing scenarios, how that can be affected if certain revenues don't come in as expected.
Right, so coverage will be a key metric that, you know, an investor would look at, rating agency will look at, because they really want to know how much revenue do you project to have above and beyond the debt service that you have to pay out. And so for purposes of this, we're assuming that your net revenue would come in, you'd pay your operating expenses, and then basically you'd pay your county bonds and any.
Scott?
Yes.
Yeah, this is Walt Draper. I'm zooming in. I can hardly hear you. You could speak up a little.
Will do, Walt.
Thank you.
So the coverage being a key metric that rating agencies or bond investors will look at, as Ryan explained, it's net revenue and compared to the amount of debt service to be paid. So, you know, as we're getting down to the, 127, that's getting to a level that, can be concerning, and that we'd have to make sure that we could find investors to purchase those bonds. To the extent that it's not issued directly by KPFD, then it becomes less of a concern, because then you're having another entity issue it, presumably it's general obligation backed by them. So really, it would be KPFD supplying revenues to pay for that debt service, but ultimately investors would have the comfort knowing that, you know, the payments should come in from KPFD, and to the extent they don't, then it's general obligation backed by the issuing entity.
Scott, I have a question.
Yes.
So they check the pro forma coverage ratio prior to the issuance of the bond. Is it ever vetted throughout the course of the bond and looked at again?
You will make periodic, well, so to the extent this is issued publicly, you'll make annual disclosures to say, almost like this. So we've brought in this much revenue. In actuality, this was our debt service and this was our coverage. So it is an ongoing look as you go on. But yes, when we go to the rating agency, they'll absolutely want to see a pro forma like this, and they may then do stress tests against it. You know, either they're potentially harsher than we would look at it.
I have a quick question too. So the 1.27, you said that the investors or whatever who buy the bonds would have a problem if we issued it and it was 1.27?
I would be concerned about the rating and the ability to sell it at that level.
So, but if we had someone else issue it, that wouldn't be a problem for that?
Correct. I mean, still, we would want to make sure that we haven't committed the district to more revenue than you're bringing in.
But I was going to say, would the 1.27 matter to whoever's backing our bond then? Whatever government entity, would they look at that?
Yes, I think they would. So, yeah, if...
As much as like an investor would?
I would expect that they would look at you, but then again, you have an investor that may be outside of your community as opposed to an entity that would provide a guarantee who's in your community. So they might know you better, but I would expect that they're going to be looking at this metric like an investor would.
So the 1.27 is kind of a warning flag for whoever, whichever way we're doing this.
Yeah, and I don't want to say that we wouldn't be able to do it, and a lot can change here in the next 2-3 years, but I do just want to point out that's a key metric, and it's getting to a level that would concern me.
Okay, thanks.
Scott, I have a question too. Is there a downside to the PFD to have Port Orchard issue the bond versus us? Just given the additional cost in terms of interest rate and the 2.5 million, et cetera. I don't see what the upside is for us to do it versus Port Orchard.
No, I don't think there's necessarily an upside for you. The upside to the other entity of having you do it would be not to count against their own debt capacity, for instance. But as you pointed out, we expect it would be more expensive, and it does provide a bit more constraint on you because you wouldn't want to put anything else on a same level as that debt, issue more debt yourself if this scenario played out, because you simply wouldn't have enough revenue to even sell those bonds.
And when you said that if Port Orchard put the bond out, it would likely be more like a 4.5%, so that debt ratio goes higher then.
Well, so what we've shown here in the KPFD issues it scenario is at a 5.5% interest rate, and we have added on a reserve account. So basically, you would be bonding for the amount of the project plus about a year's worth of debt service, and that amount would be put into a reserve account and just sit there. As opposed to if Port Orchard, say, bonded it, we estimated rates at 1% lower, just because, and not to get hung up too much on the rates, we're just trying to say there would be a difference between KPFD doing it versus the city doing it. And then in the case of the city, we assume that there wouldn't need to be a reserve account. So there's savings, I guess, both in interest rate and in the amount borrowed.
Yeah, and I guess the other question is whether or not it came up, what if the Kitsap County was to help the district in lending, borrowing the money? And so, we put I don't show it here, but we do have it. We did run the scenario, and, we've estimated they may also want a reserve account because it's not their project, not their debt. We don't know where they would fall, but I guess essentially it would cost even the county, assuming they use the exact same interest rate as the city, they end up getting the same interest rate as the city, We expect it would cost them about $700,000 more than if the city issued the bond.
Right, so we're just including the fact in prior debt, when the county has issued your debt, they have requested a reserve account. So in that case, you'd get the benefit of a geo backing lower interest rate, whether the city or the county did it, but we expect that the county might ask for a reserve account.
And then the last alternative solution is if the district was able to issue a sales tax bond, revenue bond with a contingent loan agreement with either the city or the county, which is essentially additional backing to give them more security. That would then help, bring the investor some ease, potentially lower the interest rate, as well as maybe, whether or not the reserve account would be needed. All those things would then be in play if a contingent loan agreement was available also to the district.
Another question, where does the reserve account come from? Do we pay that up front, or is it taken out of the bond proceeds?
Both. So it's taken out of bond proceeds when the bond is issued. So an amount would be built into the issuance of the bonds. So in the instance where we're talking, $6.5 million for Port Orchard, there would be that would go to the project fund. An additional amount would go to the reserve account.
And then on the option that Ryan just mentioned, so if I simplify that, that would be if the city or county co-signed with us? That's right, and that's a very common mechanism we've seen, whether we're talking some debt issued, say, by Spokane PFD or even Lewis County PFD. Those entities have issued their own debt, but they have what's called a contingent loan agreement, a cosigner, that says, if there's a shortfall in any particular year, the county, in these cases that I'm talking about, would step in and pay the debt service. Now, it becomes a loan, but still that gives investors comfort that there's a backer should there be a shortfall in debt service, or in revenue.
Any other questions, I guess, regarding some of these scenarios for City of Port Orchard's request before I move on to the City of Poulsbo? All right. So the City of Poulsbo has asked that they're going to issue their own bond of $7.8 million, and as well as cost of issuance. We're assuming here it's going to be potentially issued later this year with debt service starting to be paid next year. So we're using a 4% rate for that. This bond would also complete the financing. I'll zoom in on this so that folks can see it a little bit better here. But pretty straightforward as far as, as we mentioned, kind of the difference between because the city's issuing it themselves, we see that the debt service coverage ratio is not affected. And then the last request is Kitsap County, the Port Gamble Heritage Park project, is that they're asking for an additional $350,000. So the number here before was 932,000. It's now up to almost 1.3 million. Okay. And we're not assuming, although that they have mentioned before, we're not assuming any additional phases will be funded at this time. And now when we look at all of these layered on top of each other, and we'll zoom in here again.
And as Ryan's zooming in again, just because it's the higher cost, we're showing, I guess now, as if KPFD is issuing that Port Orchard debt. And even though we're showing it in two columns, we're showing it because one was ILA that's currently outstanding and the other is not. When the bonds would be sold, they'd all be sold together. So those would be all summed together, but we're showing it separately for now.
That's correct. And I think, for demonstration purposes, I guess if we wanted to look at various scenarios, it'll demonstrate very easily if we wanted to break up, I guess, treat the new request different than the current request, than the ILA as the ILA currently stands. And so, as we've talked about here, all these projects are certainly can be accommodated. We talked about essentially it could be a little bit cheaper to do it if the entities that are requesting or the county issues the debt, just because we want to watch that coverage number. And now we'll move on to a couple of the questions that we have, kind of from this point. Does anyone have any questions regarding the requests and how they layer on top of each other before I move on to outstanding questions that we have right now? Okay. So some of the outstanding questions we have is, of course, who should issue the bonds? Would the KPFD treat the additional request from Port Orchard differently than the original ILA? Can that be split up as we talked about? And I think part of the question is, will the city of Port Orchard issue? It really depends on whether or not they have the debt capacity to do so down the road. I mean, it's not about necessarily today. It's maybe some of the other projects that they have outstanding. So understanding, what their debt capacity is. Right now we're assuming that the district will pay cost of issuance and interest on all of these projects. So is that still the case? Or do we need to update any of those assumptions? And I guess really should a maximum annual debt service dollar amount or an interest rate limit be included on those ILAs? Who's going to be taking on that interest rate risk or the construction cost risk if costs of the projects go up, or if interest rates, particularly some of the Port Orchard project isn't asking it to be bonded for 3 years. And so, we hope that interest rates don't shoot up 3%, but certainly I guess if they did, how would that then affect, the district's budget and who's going to take on that risk? And so just something to think about as you're contemplating the future ILAs or amendments to the ILAs. And Russ brought this up, kind of, and I think he's going to follow up a little bit is, will these projects need feasibility studies, feasibility reviews conducted by the Department of Commerce? And does it matter if the feasibility, review is conducted? Doesn't matter who issues the bond if a feasibility review needs to be conducted. I'm going to phase into stress tests. So what we're going to do here is we're going to assume that in 2024, a 5% decrease in sales tax revenues, and then resuming the 2.5% increase in every year beyond that. As you can see here, the debt service coverage decreases to 1.17 in 2026, which means if revenues decrease in 2024, trying to issue the bond in 2025, that coverage ratio might make it much more difficult to sell the bond in 2025 because of what it looks like in 2026. And maybe even more concerning is that your total cash reserves at the end of 2031 are down to $11,000. So I will zoom in on that just so we can kind of scroll along through here if anyone has any questions on this base stress test scenario. And then I will show, one that is harsher and then one which is a softer decrease in 2024.
Yeah, why don't you stay there for just a second, Ryan? So I guess just to reiterate, what we're stressing here is if you look at 2024, you see the negative 5%. So all of those in previous slides we've been showing have all been at a steady growth of 2.5%. So in this case, we just changed the 1 year to decrease it, in this case, by 5%, and then each year goes back to the growth rate we've been talking about. So again, just to show, what maybe a mild recession could do. If you look at history, of course, you see increases have been much greater than 2.5%. But before we would ever want to issue bonds, or I think as you're talking to your project partners, you don't want to be assuming that you're going to be having the great years that you have been having. You need to assume at a lower rate. And so that's why we've selected, in this case, 2.5%. But Ryan, continue with the stress test.
Yep, exactly. And so we see, the coverage ratio dips as well as, your end of the year. And this is the rollover from the previous year is how much cash reserves you have on hand in this particular stress scenario. The second test we have is a decrease of 10% in 2024 with the continued 2.5% for all those other years. Your coverage ratio goes down to 1.1%. But as you can see, the district actually will run out of cash. And so you will have no available funds. You'll be negative in funds for a number of years. You do end up coming out positive at the end of the day, assuming you can get a zero interest loan to cover those years during those years. This is maybe a little bit more extreme, but just we did want to show, well, potentially we did see decreases during the Great Recession of numbers near this. So we just want to show what that may look like. And then the last scenario that we have here is a decrease of 2.5% in 2024. We do see the debt service coverage drop to 1.2, below the 1.25 as we talked about. Maybe something that we can structure the bond to help alleviate that. And your cash reserves are maintained above $500,000 through 2041 at any point. I'll zoom in another time here just so folks can see this a little bit better. And then minus 2.5% in 2024. And then lastly, just to have a basis for where we pulled our assumptions from, we have seen the market perform pretty well over the past week, but we're looking at, I guess, generally, we'd use these as more or less plug numbers, but really want to show is, one, if there are slight increases as we work out, we've created a little buffer from now until 2025 of 25 basis points every single year. And then really trying to show the difference between a general obligation security and a sales tax revenue security, depending on who issues the bond. And of course, actual rates will certainly differ from what we've had so far. So I think at this point, we're open to additional questions, and I can pull up the model and we can look at different scenarios if anyone would like to see other scenarios.
Ryan, Walt Draper here. I'm zooming in. What are the approximate actual interest rates now for general obligation bonds? And if anybody out there is getting sales tax backed bonds, what are those compared to the numbers you just showed us?
The numbers we're seeing right now, I guess using a 20-year bond as an example, we're seeing somewhere around the 3.75%. And we have seen maybe a slight
for general obligation as opposed to the 4 that you have in your model.
Correct, for general obligation.
Yeah, okay.
Yeah, and as Ryan said, there's been a lot of movement recently on general obligation bonds. The market's been trending in the right direction currently. And then I think as far as sales tax revenue bonds, hard to say. I don't think we've seen any recent sales of those. And then I can
imagine you don't see those very often.
Right. It depends on coverage then. But there's other revenue bonds that are sold. But again, I think that's why we put in, at least to be conservative, I think a 1% over a general obligation.
So just to kind of
thank you.
Just to distill this down from that slide a couple back, is it the ultimate conclusion that we can afford to do all of the asks? I'm not saying it's a should we or under what terms, but can we is kind of the bottom line I want to get to. And then we can talk should we in details and terms and things like that.
Yeah, I think, and Ryan, please correct me if I'm wrong. I mean, I think based on what we see up there, you have, and based on the 2.5% growth rate, that you have enough cash to pay debt service on Port Orchard, the PERC, and I guess the current asks from Kitsap County and Port of Bremerton. So that's what we see. Now, yeah, we get into more questions later as who bonds for it, and is that a challenge? But does it look like there's sufficient revenue to pay these? It does.
Darren Jagosinski, I wanted to, excuse me, say thank you for the presentation. And when you had first started building this model, I believe we were using 2% as the number. We were going as conservative as possible, and there were 2 others that were 4% and 6%. So I wanted to ask the question, 1, why did we choose 2.5% now? And then 2, historically, isn't it about 4.5, something like that, since the KPFD has existed, that has been the actual average, if my memory is serving correctly, but we're still using a conservative number compared to history. And I just wanted to make sure that board members who hadn't seen it before knew that and knew the history of the assumptions.
Yeah, so I think, to your second question, I don't know what the historical growth rate has been. I think on the 2.5, I think besides our model, I think you had previously had a model from your executive director that had a couple of cases of 2%, 3%, 4% growth rates. So we decided to stay, I guess, still in the conservative side, what I think it is conservative, but we split the difference. So we're at 2.5 is what we selected there. But we can, again, stress the model easily, decrease that, change year after year, whichever you would like to see.
So I've been on the board a long time, and I remember back in 2009 and 10, I believe we did have negative growth rates.
Absolutely. No, that's, yeah, and I guess we don't have the data there, but that was a very common problem. Again, you had a lot of PFDs that started up in the early 2000s, and perhaps we're assuming growth rates of, 3%, 4%. And then, yes, with that downturn, there was a lot of negative sales tax revenue around the state in that time frame.
Now, you had mentioned that a bonding agency might look at our 2.5% and want to be even more conservative than that.
I would expect that they would take this model and they would stress it themselves.
A little more.
And whether they zero it out and say, I assume no growth. One thing they'd be looking for is are you shaping your debt assuming a growth? Again, some PFDs, when they first issue bonds, because in order to issue bonds, they needed to take into account that the sales tax revenue would grow. So certain PFDs had their debt tilted so that it would escalate over time. So I would expect, again, a rating agency to stress that. What we're showing here, I think in all cases, is a level debt service case so that it's equal payments each and every year.
So how long before the Port Orchard bond would we be able to get an accurate idea of what the interest rate would be? Because that's quite a ways out. Is it 2 years maybe, a year and a half?
Well, I guess the closer we get, the more we'll know. But, it's, we just wouldn't know until, you don't get the interest rate set until you sell the debt. You probably start the process to issue the debt about 3 months ahead of time. But again, as we get closer and closer to that time, we'll be getting, more and more information. But, rates were 2% lower, a year and a half ago. So we were in an extraordinary time. So rates can change quite a bit over a fairly short period of time.
Okay, so we really won't have an idea for a while then?
We really don't.
Okay.
No, sadly, that does get into the crystal ball, which, we just don't know.
I think Phil was asking the question around should we on these projects? And this looks like we can, right? It keeps us all within the 1.25 without an additional ask from the county. I know we have been working on that with Russ and seeing if the county knew what their future plans were. But I don't know, because I had seen this presentation once before. At the end, all the way to the right, Ryan, there's a balance here. So, guys, this pays all the debt that's kind of put forth between Poulsbo and both asks of Port Orchard, the original, and the additional ask that they've brought to us. And then it still leaves, what is that, $9 million there, Ryan?
Yeah, and you see a lot of it comes, you see a big jump from 2040 to 2041 because the reserve account makes pretty much all your payments in 2041.
So I guess what my point I'm trying to make is while we're funding Port Orchard and Poulsbo through this process, we may just have to look at a different mechanism for the county, and maybe they take a full $9 million at the end. And then I think my question then would be more towards my peers who have been on this board for some time. Was the general consensus when we extended the sales tax rebate, and I think that was 17 or whenever it was you guys got that done, that it would probably be done again and that we would continue to receive these funds past 2041? It's my understanding that other districts will rely on that money because they own their buildings as opposed to this district?
I have an opinion on that, John. I think it's extremely unlikely that in 2041, the state will say, we're not doing this anymore.
Yeah.
Now you can't count on it, but I think it's a very popular program. It has broad support throughout the state amongst the county governments because PFDs have done a lot of good things. And to think that they're just going to turn their backs on it in 2041, I think is a long shot.
Yeah.
I would echo what Walt said. I don't think we are given an expectation that that would happen. I don't think there was ever any language that was given to us by the legislature, by the governor, or anything of that nature. But it was, I think, an assumption that we all made of who would stop it, especially when we're one of the only PFDs that doesn't own the assets. Other PFDs have ongoing operating costs that they have to pay for and use these sales tax revenues to pay for. So we're in a good position that way. So last time it was 7 years, is that right, before it was going to expire, that it was reissued, something close to that. So maybe they would do something similar, so 2034, who knows? But I would guess they would want to do it before, way before 2041. That issue will never get that far. We'll know, I think, closer.
I wanted to share with the board that today I talked to the new county treasurer, and I talked to him about would the county entertain at least a discussion if we came to them about the county carrying the bond that City of Port Orchard is asking us to do. And he said they'd certainly be welcome to the conversation. What he would like to do is when we get to that point, he would like to get together with us and County CFO Amber Dunwoody to take a look and see what that looks like on what their debt capacity, what their bond capacity is going to be. But he indicated that yes, they would be open to the discussion. He also said that if that's the direction that we decided to go and it made sense, then we would then sit down and have a meeting with the county commissioners like we had in the past and present the idea to them, because after all, they're the ones that give the final approval of it. But I did want to let you know that I have spoken to the county on behalf of the PFD with regard to that particular bond.
I also wanted to ask the question of, or I guess it's not even ask the question, unless there is information we have that would say that the county isn't planning to come back to us. But from the very first time we heard their request, they were at 15 million, I think the number was to start with. And then they said, we think it'll be closer to 8 some million because we can get other funds that would come in as we have the PFD's money come in. And so they may not have asked us, just like the city of Paulsbo had not asked us, but both of those entities were going, I forget the right term, but it's one step at a time, and you do your ILA and you finish it, and then you go to the next one. Whereas Port Orchard was in a position where they needed us to commit to everything because otherwise they weren't able to go forward. So that was the history of it. I would totally expect the county to come back and ask for more for Heritage Park.
And I've reached out to the county and particularly to Mr. Baker on a few occasions just to ask him exactly what what additional construction they'd be looking for, knowing that the original was projected about $8 million. And the only thing that he's ever responded back to me was the $350,000 asked, that they asked back in March, I believe it was. But I still haven't gotten any kind of a dollar figure from the county. I agree. I think that at some point, I don't know when that would be, maybe 10 years from now, I don't know. But at some point, they'll come and ask for more money. But right now, they're not. And that's the reason why I don't have a figure that I could give to Ryan and Scott to put into the model.
So I have a question, and it's probably a dumb one. I just don't know the answer to it. So let's assume we give some or all of the money that's being requested to the various entities on paper. What happens if either the project doesn't happen, or again, due to economic reasons, they run out of money? It's, inflation and all. Either A, we get into that scenario, they come back to us, and let's say at that point we say, no, we don't have the funds to do it, or it's this, we're not a blank check. What happens to the funds that we've given to the various projects up to that point, or promised up to that point? Do they get released so that we can use them on other projects? Do they stay in the kitty kind of indefinitely on hold to see kind of, maybe does this go forward, maybe does it not? I mean, I guess I want to get into, if we're going to start talking about whether to fund it, kind of into what are the terms, what are the requirements? Is there a deadline by which if the city of Port Orchard says, we're doing it, but we need more time to get additional funding, and then inflation happens again, and now they need more money, and the budget goes through the roof, and, ground is never broken, and it kind of peters on. At what point do we have control to say, okay, all that stuff that we promised, put in the ILAs, that comes back to us, because it needs to be freed up? Because ultimately, 2041 may come around, and the state may go, you guys didn't actually use the money. We are going to close you down and use it for other projects or something. I mean, I'm just going worst case, catastrophic down the road, but I'd like to see it actively being used. And so far, all of the projects are actively pursuing. I just get concerned that things happen and get delayed. So before we start writing additional checks or making additional promises, what are the restrictions?
Yeah, I think that may be a board policy, but maybe Brian, I don't know if he has an opinion on the existing ILAs and how they read.
This is Brian. I can partially answer the question. The ILAs we've been developing have a series of checkpoints in them. One of the checkpoints is a schedule. So, the 3 projects are on schedules, and as we know, when they fall behind the schedule, they come to us and say, we would like an extension. Our ILAs also require that they have a funding plan for the non-PFD portion of the plan. We also have a checkpoint that simply says the PFD donation is subject to availability of funds. So again, we've built a series of checkpoints into the ILAs to date. Phil, you're correct. We've never had a failure, which is great news. But they can happen, and it would always be worthwhile to take a look at our checkpoints and decide if they're enough or if we need more as we go forward. And the funds themselves, because I think this came up in the 2013 time where PFD had a little bit of extra money and went back to their partners and said, we have some additional funds. Do all of you want to apply for something? And each of them did, and each one was given a grant, and 2 of the 3 never followed through. So those funds simply got reallocated to other uses.
I'm thinking of a scenario. What if they, again, I'm going to use the city of Port Orchard just as a concrete example, not based in any reality at this point, but let's say they meet their temporal deadlines that we've put in place, the checkpoints, but again, construction costs go through the roof. So by the time they hit checkpoint X, when they're actually in construction, what do we do? How does that work in terms of funding? They're not able to do either the project they think they're doing, something along those lines. Not because of anything they're happening. I'm just looking at inflation issues, and I'm dealing with clients of my own who have construction issues, and projects are falling apart.
Yeah, that's kind of the nightmare scenario, right? That a lot of funds have been committed and then the project sponsor can't pull it off. I don't have an answer to that. Just hope that in all of the build up to the planning on the project sponsor side and in our review, that we're looking out for that possibility and trying to mitigate the risk as we go forward.
Yeah, and I think that kind of gets into, again, a board policy of how much do you want to reserve for these possibilities. You know, do you want to reserve anything? Or if there's an economic downturn, you know, how much do you want to assure that you're going to be able to pay all of the projects their, you know, annual ask? So that's, I think, something we can help out with as we're going through and looking at the model and stressing things and seeing how much funding looks like there'd be available.
I'll share my perspective on that and kind of a wider perspective too for, you know, not just these partners, but for future partners and how I think of that. For the question that Scott and Ryan ask of should a maximum annual debt service dollar amount or interest rate limit be included in future LAs, who takes on that interest rate risk, who takes on that construction risk, that's where I have preferred having a clean number where we commit to these different public entities a clean number. We do not commit to interest. We do not commit to construction cost increases. We commit a number to them. They are the ones who own the asset. We don't own the asset. We don't have any control of it. We are just a funding mechanism. Someone used the word donation. I like that. That's probably the word we should use. It's a donation in many respects. We are partnering with them, but they will own the asset, and that's the way we like to do it. So I like it clean like that, and I think that gives us a lot of flexibility and takes away the risk from us that we've been talking about. In the big picture, when this first came about and we were going to get extended out to 2041, I didn't ever think that these would be our only 3 projects. I thought that there would be Bainbridge or other public entities who would want to come and request, and that we needed as a board to figure out what's our long-term plan that way. Are we going to do this every 7 years, every 10 years? But I think when we did it last time, we put it out and we gave like a year or something of that nature, and we had a flood. But everybody's coming with their ideas as quick as possible. If we could establish a schedule where we say, next time in 2030, we'll be doing the same thing. We have no idea what the money will be. We have no idea if it'll be extended by then. But in 2030, we'll do the same thing. It gives different cities, it gives different public entities, it gives entrepreneurs the opportunity to know that that's coming, to start planning, to think, to dream, to think of like how they might even schedule their own debt service to coincide with that money being available. I just think having that long range kind of plan for us is a good thing, rather than thinking these are our only partners for the rest of time, and you know, but for us to pick that, whatever year that is in the future, that we would establish that and that we would let people in the county know that.
So I just want to make sure I got this. If we were to fund everything that's up here, correct? We have no wiggle room. If anything goes up, we have no more money basically to give any of them. So if Port Orchard came back and said prices are gone up, we're going to need $8.5 million in 2 years instead of 6.5, we would not be able to do it with this scenario.
Well, I guess, again, it depends on who bonds it. If Port Orchard bonded it, I mean, it looks like based on the 2.5% growth rate that we're left with, you know, $9 million at the end. I'd have to see what the annual remaining amount is and how much the additional ask would be. So I guess it sort of depends on how much the ask is, who's bonding for it, and what has changed from now to when the bonding happens. But when we're looking at the stress scenario, it does not take much to turn things negative.
Right, that's what I'm kind of looking at.
Right.
So it looks to me like we're pretty much almost at our max with.
Right, but I guess there again, it's a bit of it's maybe messaging. Again, if Port Orchard's doing it, or if somebody comes in and says, I want 2 million, I want 4 million, I want 6 million, we can look at the model and say, at whatever stage, and say, things are looking great or things are looking pretty thin, and if we do offer this to you, maybe you're at this level. So we're going to commit to all the project. We're going to commit to anything we've bonded. We're going to make sure we can pay the projects that we've already committed to. We'll plan to give you, X number of dollars per year. However, if that doesn't come through, you're the first to get a haircut or something like that, or you don't get funded. So I think it can be done. It's just, everybody's eyes are going to need to be wide open as to what their order of funding priority is.
Okay.
I know a comment was made about this new ask for Port Orchard for the increase. If they were to bond that themselves rather than the PFD doing that, we bonded the original amount and they did the rest. These numbers change dramatically too, right?
Yeah, we'd probably get somewhere in between the two Port Orchard scenarios that we showed you, because we showed one case where it was all Port Orchard and one case where it was all KPFD, so it would be somewhat split. So you would expect then to see that coverage number to be higher than what we're showing right now on the screen, because a portion of that would be done by Port Orchard.
I wanted to ask, Ryan, would you, instead of 2.5, put 4.5 in the change, just for humor's sake?
Absolutely.
And run it down there with all of the requests funded. So, as we are looking at this, you can see just how big of a difference it makes based on how much money, comes in based on that increase. And when we went through the pandemic, we were all very nervous that it was going to have the opposite effect, that it was going to go down. And we had a couple of months of that, but then it overall went up even more, and there are reasons for that. But just to say, this is a bunch of variables that we're trying to make our best decisions with, but if you, and I think this is the historical number, but I could be way off, I'm sorry if I am, but we'd have 22 million left over with this, and so 2.5 is a conservative number that we think is a good number, so we'll make plans for somewhat, we'll make them conservatively, but there is upside here too that could happen.
Yeah, and I agree with that. But I do think that the 2.5 conservative number, if the bonding agencies are going to look at it and give it a haircut and possibly look at it even lower than that, then we have to take that in consideration, so that if it does historically give us 4.5, 5-10 years from now, we're funding more projects because we'll have the cash. So.
Yeah, I would agree with that we don't commit to projects with a 4.5 expectation, but that is part of our, we can invite more people to come and ask for money later fund.
Right. No, I think that's, I think you want to have your what ifs in both cases, trying to figure out what you're going to do, so what happens in a bad case, and then what happens in a potential better than expected case, how do you handle that?
Hey, Russ, you said you spoke to the county about potentially doing some of the bonding. Did the idea of this contingent loan agreement come up, whether they'd be interested in that?
No, we hadn't talked about that. The other thing I wanted to mention too is that we had heard earlier, Ryan had mentioned something about my asking the question if we need feasibility reviews by Department of Commerce done. So I've sent an email off to Angie Hung and asked her that question, and I'm waiting to hear back from her, but I'll report back to the board as soon as I know, because that's something else that we'll have to factor in as well for both the city of Port Orchard and for the city of Paulsville, if we move forward with that.
I thought the feasibility studies were required if we were doing bonding. Does that kind of tie with what you
I
said?
agree. I just wanted to know, is there any kind of threshold limit amount, right, that says, okay, if it's under this amount, in other words, if it's under 10 million, you don't have to do that? Does it matter what amount it is? I was just wanting to know in general terms so we can be prepared if we're going to have to go do that. I think one of the biggest questions for us is that we don't know exactly when the funding is going to be needed, and especially with the city of Port Orchard. So there's a lot of, what's that interest rate going to look like if we do it, if the county does it, if the city's in a position where they could do the bond and then we do the debt service. I think with regard to the city of Paulsville, the last time I talked to them, they said Q2 of 2024. Would be when they would be asking us to start paying the debt service on approximately $8 million. They're going to make a presentation to us in 2 weeks at our regular board meeting, so I think that we ought to ask them the question, when are you really looking for these funds? When are you looking for us to start paying the debt service on that? The one thing I don't quite know yet is that I thought they were shovel ready and ready to go. So I don't know what the delay is now that they're saying Q2 of 2024 is when they ask us to start paying the debt service. I don't know. But that's another one that we don't quite know when they're going to ask us, and then we have to make a decision on whether or not we're going to obligate to that. So that's part of this. I think that looking at the model in a worst case scenario is the best ways for us to look, because if that's as bad as it gets and we know that we can survive something less than that, well, then we'd be in pretty good shape.
So what's the advantage for the county to do a contingency loan? It seems like if we have to have one, they're worried that we're not going to be able to meet our obligations. So why would they want to do that?
Well, it's kind of a hybrid, say, between them directly issuing the debt and you directly issuing the debt. So in the case of a contingent loan agreement, you would issue the debt, but the county would provide a loan to you to the extent that you don't have sales tax revenues to pay for your own bond. So it's certainly no benefit to the county to do it. It still counts against their debt capacity to give you that guarantee. It means they don't have to issue the debt, you issue the debt. You would issue the debt as a sales tax revenue bond, essentially backed by the county, as opposed to the county doing it directly. It is a middle process. It's not as clean as if the county did it itself completely, or the city of Port Orchard for that instance.
Because it seems like you'd only have to do that if there was some concern that you wouldn't be able to meet your obligations.
Well, not necessarily. I mean, I guess with a sales tax revenue, unless we're talking, we're bonding $50,000 and you're bringing in $10 million a year, then, there'd be no concern. But there'd be a benefit to an investor to have the knowledge whether or not you think you're ever going to need it, to know that the county is there, because then they don't necessarily need to look at your revenue stream. They look at the county then and say, oh, the county has plenty of resources to pay debt service if it ever gets to that. So there's sort of two steps, first the sales tax revenue and then ultimately the county to provide a loan to you, which you would then pay back.
Okay, thank you.
Do we know what the city's debt limit is or how close they are to hitting it? I'm just, again, interested in them issuing it, and if there's a reason that they either cannot. I mean, I understand they may not want to, but that's different than they cannot because they're already close up or they've got another thing on the books or something.
Right. So we've estimated. Now, again, we've not spoken to the city of Port Orchard about this, but in looking, so a city's non-voted debt capacity is 1.5% times the assessed value within the city. The city of Port Orchard's assessed value is about $2.5 billion. So that would give them a top statutory debt capacity figure of about $37 million. From that, you would deduct outstanding general obligation debt, which, again, by our estimate was about $4 million, $5 million. So I think we figured maybe it's around 33 at this point. But then again, there could be additional projects that they have then that they're wanting to reserve that statutory debt capacity for. And honestly, we could have it wrong. I believe we have the top number correct, but we may have missed some general obligation debt. But 37 million looks to be the top number based on 2022 assessed valuation.
I think I'm a little confused about the difference between the sales tax revenue versus the other form of bonding. When we're talking about the contingent loan, we're talking about it based on sales tax revenue, but what's the difference between if we bonded the city of Port Orchard? Is that because there's a physical building involved and it's bonded against the building versus, what's the difference?
So again, what's the difference between if you do it with a contingent loan agreement versus if somebody else does it? Is that,
No, actually, like we talked about, we looked at a 4%, I think,
Right.
versus 5% with 100 basis points difference. What are the two different kinds of bonds, and which one do we normally use?
So the KPFD has historically had its debt issued via the county. And so the county has issued a limited tax general obligation bond, and the KPFD has then sent sales tax revenue payments to the county to pay on that debt. So again, it's officially a debt of the county, but it's payable by the PFD. At the other extreme is no contingent loan agreement, no county, no city issuing the debt, but the KPFD issuing its own debt. And in that case, investors have only one revenue stream to count on, and that's your sales tax revenue.
So if we issue the debt by ourselves, we're at the higher interest rate.
Correct.
The 5% rates. Okay.
Correct. We are assuming if KPFD has to do it, you're at a higher interest rate, and we're also assuming, for purposes of these numbers, that you would need to then increase the borrowing amount to set aside funds into a reserve account.
So does that mean that the city, when they look at their revenue stream, they look at everything, property tax, business tax, everything to pay these back?
Yeah, I mean, if the city or if the county, correct.
Yeah.
If the city or county, it's a full faith and credit pledge to a bondholder that if I'm not getting funds in from the KPFD to pay this debt service, that I will pay with my property tax or other funds that are available.
Because they have multiple streams coming in,
Correct.
and we just have the one.
Correct.
Okay.
Right. Yeah. So it's a much bigger pledge. So somebody doesn't have to worry about the cyclicality of sales tax revenues. They can look over here and see, property tax revenues steadily increasing.
So for the city, for the bond capacity, it sounds like it's kind of like maxing out a credit card. They're not going to want to go to, let's say, 37 million.
Correct.
They want to keep a reserve in case
Right.
something comes
There's
up.
a statutory debt capacity, and then there's also the ability to pay. So a lot of times an entity just couldn't get up to their statutory debt capacity because they just don't have the funds to make a payment. But yes, I mean, other times, if it's getting close to their debt limit, they might say, gosh, we want to reserve some of that for unforeseen events, litigation where we have to pay out money and perhaps bond for it,
So you couldn't really just expect them to say, we're going to 37 million for you, our max. You would expect them to want to be lower and keep some in reserve.
Yes. No, I would think that'd be prudent of any issuer to not max out their statutory debt capacity.
Okay.
Would you give the specific numbers again? Because I hadn't ever heard that before, so I'm just interested in that. It's the assessed value of all the property in the city limits?
Correct.
And so that
houses,
number for Port Orchard was again?
In 2022, for the collection year 2022, it was about 2.5 billion.
Yeah. And then what was the percentage?
It's 1.5%. So
Okay.
that's the non-voted debt capacity. Then cities have voted debt capacity, but that's not what we're talking about here.
Thank you.
All right, is there any other questions while we have them and have Ryan online? Do you feel like you have a much better understanding of current state and what future state could look like? Okay. Well, Scott and Ryan, we both thank you very much for all the hard work that you're doing to put these models together for us and give us a glimpse at it. And I know we'll continue to work towards this as we look at requests, future requests, and so forth. So, Mr. Chairman, if there's nothing else, would you like to adjourn?
Just thank you very, very much. This is very informative. Thank you.
Great, thank you.
Before you adjourn.
Yeah, if anyone thinks of any scenarios, feel free to reach out to Russ and we'll be able to run those and get copies to you.
So I just have a comment more for the board, something to consider as we adjourn or before we adjourn, is that it appears to me that we might have a few different ways to approach this with our funding partners. Personally, getting into the bonding aspects of things is probably the most distasteful thing that I can think of that we could do. So we could provide scenarios where instead of saying we'll give you $6.5 million and bond it, we'll pay the debt service if you bond it. And then if you don't have the debt capacity to sustain that, we'll bond it, but we'll at a discounted rate of, say, like $5 million. Is that a realistic scenario? And that would give them an incentive, because we are bringing a valuable gift to the table to them, and that's money that they don't have today. And I think we can make our money go a lot further by paying the debt service instead of going out and bonding on our own. So.
I agree with Tom on that. I mean, I think kind of as a hybrid between what Darren was saying, or an amalgam, I should say, of what Darren was saying. I really like the idea of setting a schedule for future projects, and I think that we as a board should discuss that further, and not even 2030, something sooner than that, give people the lead time. But I like the idea of going out to the public. Again, part of it is our marketing of, we're going to be, can't guarantee any amount, can't guarantee specific projects, bring it to us, but I'd like to have some money available to do that. And so if there are creative ways that we can say to Port Orchard and these other projects of, okay, we're willing to help you fund, but if that means you have to take more ownership of things like bond it yourself so that we can do these things for other projects in the future, that would be my ideal.
Off of that, I think if we set the year, whatever that year is, we can say that we're going to go through this process again on this year, but a year ahead of time, a lot of these variables will be cleared up. We'll know what kind of sales tax has come in. We'll know, have all of these projects been able to go forward for the next 4 years or whatever that number is. And we'll have an understanding of how much we may have. We'll have some kind of a threshold. We won't have an exact number. But then a year ahead of time, we can put out, we expect that we will be awarding $10 million to $15 million at this, and that may be one project, that may be two, whatever. But I think if we set the year, then a lot of those variables just have to do what they do. And then a year ahead of time, we can give the actual numbers that people can expect.
Do we have any other comments or questions?
I guess my only question is, where do we go from here? I mean, do we have another special meeting to kind of talk about globally, here's how we each envision things, and I know we can't take a vote or do a consensus at a special meeting, but, talk through the issues and then set an agenda item because I just think it's a big enough issue that if we set this at a regular meeting with all the other stuff that goes on at a meeting, we'll be in for a 6-hour meeting, and I don't want to do that. But if we do another special meeting, even if it's by Zoom, I'm fine with that, but at least to discuss what are, again, with what we've heard today, what are the options, what's a general preference, and then we can, put something on the table for a regular meeting.
Yeah, what I'm hoping is with the information that we got from this meeting, these will come up. I mean, we're going to get a request from Paulsbo. We're going to get a request from Port Orchard for more money. And we'll be able to vote on it based on what we learned here tonight, on what we want to do, whether to approve it or not.
Right. But I'd like to have a kind of a bigger holistic plan. I mean, we could say, okay, Paulsbo, we have the money to fund you, but in the bigger picture, where's that going to look if we're, you know, are we going to do this thing and open it up in 4 years? Paulsbo, maybe because they're smaller, I don't know. City of Port Orchard, yes, but because we're looking to do this in the future, you may need to bond this yourself, and we backstop, you know, what Tom was saying. So I don't know that it's just a thumbs up or thumbs down kind of vote. That I'd like to have a consensus, or at least a general view from the board before we get those asks of what are our goals, so it's not just a vote on a kind of on a.
I mean, I'm okay with more meetings. I don't mind special meetings if we want to have one for all of us to sit down and discuss where we want to go with this. I'm totally okay with that.
I would suggest too that now that you have this information and we have an idea of what's coming, if we call another special meeting, have those questions ahead of time. So you be thinking about, now that you know the information, thinking about other questions that you want to ask, other things that we may want to put into the model to take a look at. Also throwing into the model, okay, let's say 5 years from now, we're going to go ahead and we're going to open it back up for projects, right, and give more opportunities. So what does that look like in the model if we 5 years from now are committed to what we said we're going to do or not do, and then what's that look like for the future too? So Chairman Hatchell and I have talked about it in the past, and we can, special meetings, we can have as many meetings as we need to, right? We can do another special meeting. I just suggest that the next one that we do, have your questions ahead of time so we kind of know what we're jumping right into.
Yeah, and I kind of was thinking along the lines of, for instance, Port Orchard, a special meeting with that, we could have the mayor come in and whoever he wants, and you can answer all the questions you have. Can they bond themselves? Are they willing to bond a portion themselves? And I'm assuming that's kind of the questions you have, because I have those same questions. I mean, I wish I knew. It would make a decision way easier for me. And we can have a special meeting and just invite them and say, this is what we want to know. You know, are you willing to do this, or do this, so we know exactly where we stand before they put the question to us. We can do that with Paulsbo too. Does that sound like something that would work for everybody? I mean, more meetings is not fun, but it's necessary, I believe.
When did you say Paulsbo's coming to talk to us?
They're coming in our next board meeting on the 30th.
So soon.
Of this year. I'm sorry, of January, yes.
Yeah.
Yeah.
I agree. I'd be open for the to do some additional meetings with it. And
yeah, and maybe we could actually put the questions to them ahead of time, so when they come in from the cities, or the county, they know what we're going to ask and they can have the answers ready for us.
Certainly. I know when I talked to them today, both Ms. Botten and Mayor Erickson are going to be at the meeting, and that meeting is in the Paulsbo City Hall.
Okay.
And Russ, where are we on the Circuit of Northwest? Is that under?
So the last time we had any kind of discussion with Circuit of Northwest, we had sent back to Mr. Town kind of a list of, if we're going to look at any kind of LOI or anything like that, these are certain things that you need to take a look at, that you need to include. And part of that was that rather than the PFD footing the entire bill, that we would want to see them try to reach out to other public entities like the county and the city of Bremerton, right? So I know that they were also anticipating a feasibility study to come out. I haven't heard anything from them, so I don't know if that's out or not. But I haven't had any other discussion with Mr. Town or anybody else at the port with regard to that. So, of course, we're open to those discussions again. It's just that I need them to respond back to what I had sent them back 6-8 weeks ago and says, this is what we're asking you to do, and then we take it from there.
And I think to answer both Phil's question and their thoughts about the additional meetings. I'm happy to have additional meetings as well. I don't know that we're going to decide a whole lot because there's still too many moving pieces in all this. Rates are still deciding. We don't know what growth rate we're going to have. I think by the time we bond in 2 or 3 years or go to look at bond, if we potentially bond ourselves, what if we continue to have 7% growth for the next 3 years? That dynamically changes the position that we're sitting. So I think it's good so we can start formulating what our plans are, but I don't know that we'd be making a decision at that time. And I don't know. I didn't see where if we added another project or an additional funding in there, any layer that looked like it was going to make any type of stress tests. I don't think we'd pass. It barely looked like we were passing with what we have currently obligated or in ILA.
So I came up with one additional question. So how do they determine our bonding capacity since we don't have any assessed value or anything?
Yeah, you actually do have a sales tax. You have a debt capacity for sales tax obligation bonds. And I think because you're county-wide, I think your AV would be based on county-wide assessed value. Off the top of my head, I don't know what the percentage is.
Okay. But there is a formula that comes up so we would be able to know exactly what we had?
Correct.
Okay, thank you.
I wanted to go back to Circuit in the Northwest too. If you'll remember when Mr. Town presented to us at our last special meeting, he talked about that we could generate revenue, I think approximately $3 million a year based upon admissions tax, 5% admission tax there. And so the thought was that's how you'd pay the debt service on $20.5 million. So, you know, if they presented that, if the feasibility study were to shake out and say, hey, here's additional revenue that you could add besides what you're getting with your sales tax rebate, your monthly sales tax rebate, and then against what it is that the PFD would agree to fund in any amount, then that's something else we could throw into the model. But again, we still need a lot of information from them to even be able to throw anything like that into the model to see how that would shake out.
Do we have anything else? No? Okay. We will adjourn the meeting.
Thank you all.
Scott, thank you.
Yeah,
Thanks,
thank you,
Pat.
guys.
Thanks, Russ. Have a great night.